Today we're going to talk about real investing tips that are being abused in markets where they don't actually work. Welcome to the Yugioh channel where we discuss everything collecting and investing in Yu-Gi-Oh! And sometimes just investing as a whole. I've been seeing this very dangerous little game that speculators like to use where they will grab certain words and certain concepts that work in truly time-tested markets with proper fundamentals, and then they use those words to justify certain behavior in markets where those concepts do not exist, aren't proven to work whatsoever, or in worst case are just straight wrong, just deceitful as a whole. Also, if you hear birds, too bad. Concept number 1, dollar cost averaging. The concept of dollar cost averaging is essentially that every single month you take a certain amount of money that you make, whether it's 10% of your income, 5% of your income, or 15% of your income, and you put it into the market just like that. So you're averaging a specific dollar cost consistently. This will make it so you build a position in that particular market, and depending on the ups and downs of the market, you're just riding the wave. You're not trying to time it. You're not trying to do any magic. You just think this market long term is going to keep going up, so I will be putting my money in this. That implies that as you do that, long term that market will keep on going up. If you dollar cost average down, your money just dies. You know, a market that ceases to exist, well, if you dollar cost average into that, you dollar cost average to nothing. And so this concept of dollar cost averaging is very true in proper financial markets with decades or rather centuries of proper history. If you dollar cost average into the stock market, generally you're gonna be okay. Because we know with over a century of data that generally the world gets more productive, gets more profitable, or at least has extra revenue as more people are added onto this planet, that then justifies the growth of that asset. There is a fundamental reason as to why that thing goes up. The dividend payout, the ownership in the company. However, I now see people in either crypto or Pokemon cards or all these other markets that are inherently risky and speculative going, oh, if you think the stuff is too high right now, just dollar cost average into the market. See, I just said a hard word. I just said this one concept that Mr. Bogle said about stocks. And if I say it in this market, it's also rational. No, it's not also rational. It's possible that it works out, but it's also very possible that you dollar cost average to nothing. Now, I'm not saying that all of crypto is going to go to zero or anything like that. But if you dollar cost averaged into a .com ETF in 99, I'm sorry, you dollar cost averaged into nothing. A lot of those ETFs, or well, were they index funds back then? Anyway, they just vaporized. They vanished. The underlying companies, 99% of them went up into air. Same thing with Beanie Babies. If you dollar cost averaged into Beanie Babies, well, too bad. Your money's gone and it's never coming back. The assumption that if you average down with the market, it'll eventually, come back up is ludicrous in some markets. These concepts were designed for things with fundamental values. Now, will it work out? Maybe. Again, some cryptocurrencies have proper utility and might do good. But I see so many gurus going, oh, you should dollar cost average into cummies. You should dollar cost average into SHIB or into Dogecoin. Okay, but watch out. Some of these people are selling you shit. The next nice, cool word that they like to use, buy the dip. Now, buy the dip has been very exciting. The idea is essentially that if something dips down, that means there is currently FUD or emotion, there's fear in the market, and so that means certain assets are underpriced. So if you buy the dip, you will sometimes make out with a lot of money, right? So if in March 2020, you saw this massive COVID crash and you weren't afraid and you bought that dip in the stock market and you recovered, wow, look at you, you're so smart, you bought the dip. Yes, in the stock market, that is smart. In the stock market, in a very broadly diversified index fund or something like that, or in a proper company with proper bookkeeping, solid value, maybe there's some really solid assets in there, it's actually doing well, but it's just because the CEO did some weird shit and now the company is down because of that, but it has nothing to do with the actual company. Buying the dip in that regard makes sense because buying the dip at that point is a value play and it's now down for no reason, so I'm getting a steal. That is the idea of buy the dip. And that is true. You know, buy low, sell high, blah, blah, blah. Everyone likes to use these words. What I'm currently seeing is that on extremely speculative assets that are potentially in huge bubbles, people are also saying buy the dip. You saw this asset go up 1,000% in a month. Now it's down 5% and you say, oh, gotta buy the dip. It's now underpriced. It's totally on sale. Oh yeah, we're having some sales tonight, guys. No, fuck you. You're not having sales. And you're not buying a dip. You're buying a peak that looks like a dip if you zoom in enough. Might it work out? Sure. It might. No one is able to predict anything here. But if your asset has already gone up 1,000% and then goes down 5% in the short term, that's not a dip. You aren't buying dips. And if there's no fundamental basis as to why that dip is actually an undervaluation of the thing you're buying, how are you even judging the difference between a dip and the start of a falling knife? Number 3, hodl. Hold on for dear life. You know, if something crashes, just hold. If you hold long enough, one day it'll be worth something again. Why? Why? Tell me. Again, this makes perfect sense in the stock market where you know, unless the whole planet is gonna cease to exist, you can assume that at one point the stock market as a whole will recover. Otherwise, humanity has quite a problem. But again, if you are in very speculative markets with no fundamental basis or anything like that, why would holding suddenly make that thing go up? What makes you think that 30 years from now, a particular item will go up again? That makes no sense. Again, if you held Beanie Babies for long enough, they aren't going anywhere. If you held, 99% of all those .com stocks that just crashed and never recovered, there's no amount of holding that is gonna fix that. And so once again, this type of concept works in a market that should recover. But a lot of markets should not recover. And trying to just grab these concepts again from John Bogle, where he was justified to say these things, and then pulling them into your speculative ass market where you're trying to pump and dump shit, it just doesn't work that way. And then finally, time in the market is better than timing the market. That is true. Once again, same thing with the dollar cost averaging. Very simple concept. The idea is you can't time the market, but as long as you have enough time in that market, you'll be fine. You'll have major money anyway. Once again, it depends on your market having proper fundamentals and eventually going up again. But if you have enough time in a market that isn't going anywhere, that is inherently not worth anything, no amount of time is going to fix that. Once again, the amount of time that you have been sitting in the 99.com bubble type of stocks, that .com ETF or index fund or whatever from back then, no amount of time is going to fix that. You got fucked. End of story. Beanie Baby, same shit. If you want to go to the South Sea bubble and the Dutch tulip bubble, blah, 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 sure. And I'm not saying all of these assets are in those types of bubbles. But what I am saying is that a lot of proponents inside these markets are trying to sell you certain concepts that are fundamentally true in markets with fundamentals, but have no bearing on any reality inside speculative markets that have nothing to do with real markets. If you currently dollar cost average into Genesis Impact, I'm sorry, but I don't think 50 years from now you'll have made money. Maybe 2 years from now you'll have, but I just don't see that thing holding value long term. And if in 10 years Genesis Impact has dipped down, I do not think buying the dip is a prudent investing strategy. If you then hold Genesis Impact long enough, I don't think you'll be fine. And again, if you are putting time in the market with Genesis Impact instead of timing it again, I don't think you'll be fine in the long term. Will it maybe go up 2 years from now? Sure. But again, when I'm 71, I'm not spending fucking money on Genesis Impact. So that was all. Hope you found it interesting. Just be very, very cautious when people are selling you these concepts and then trying to justify you buying into very, very high valuations of certain things when there is no cash flow or revenue stream or asset that is actually underlying on that thing you're buying. And that includes Yugioh, and that includes Pokemon, that includes all of these speculative assets. These are speculative. Blue Eyes White Dragon is not operating a tractor. He is not an IT department. I am betting on people giving more one day, but there is no fundamental basis as to why, except for I like it. And there's not many out there. Hope you found this interesting. Be sure to like, comment, subscribe, and I will see you soon. Ciao.